it's not that one other big currency takes over, but that you have a little bit more diversification of currency pricing or what kind of reserve assets central banks hold. So you get maybe less treasury purchases and more gold purchases because that's a market that they're used to. It's pretty big. Over time we'll see, for example, what happens to the size of the Bitcoin market in 5 or 10 years, or whatever else is happening here.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discusses Bitcoin and crypto. Bitcoin and stablecoins can be powerful tools in combating this issue. For instance, they can have a significant impact in developing countries. Individuals can have a preference for a Nigerian graphic designer who can conveniently present a QR code during a video call or send a payment via email or direct message. They can choose to pay in any currency they prefer, bypassing the local banking system. This method offers immense value and operates on a peer-to-peer basis, avoiding centralized gateways. Holding and transferring assets is crucial in this process, and it is essential to consider jurisdictional risk. And lots of things Lyn Alden discusses, so please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
So it's certainly important for some sectors, like I mentioned, commercial real estate, for example. That'll really be impacted by whether or not the Fed chooses to cut or not. My base case, but overall, I think that rates are a less important variable than the markets become accustomed to in recent decades. And so my base case is we'll probably see a steeper yield curve, either from higher long end on the bond yields or some cuts on the shorter end, or both. So probably steeper yield curve. So I'm not particularly bullish on, say, owning long duration bonds. If I'm going to own any of them, I'd rather own short duration ones or kind of mid duration ones. But the thing I watch at the Fed right now is liquidity. And so their rate of balance sheet reduction, I think, is going to matter, because eventually they'll get to a point where they're no longer able to run their shrinking balance sheet playbook, because they run out of resources. Like they'll run out of reverse repos. They'll run out of other balance sheet space to absorb those bond issuances, and then they'll have to go back to balance sheet increases. And that is potentially a big narrative shift when they have to get to that point. I paid attention very closely when they back in 2019 had to go back to balance sheet expansion, and that was an investable thing. Basically, it was pro most types of assets when it happened. And so I think that liquidity variable, that balance sheet size variable, matters more than the rate variable. I also look at things like what's going on the fiscal side. Is there anything on the horizon that can accelerate some of the fiscal deficits, or is, for example, if a meaningful tax raise starts to make its way through Congress and is somehow going to get bipartisan support, that'd be a huge variable that I'd be paying attention to, as well as anything revolving around capital controls or anti-self-custody or these types of things. So those are the variables that I monitor in a fiscal dominant environment, or that I'm looking to monitor, that I have been monitoring more so than what's the Fed going to do at their next meeting. Are they going to go up 25 basis points or down 50 basis points or hold steady again? That becomes less relevant than Fed liquidity, fiscal deficit size, and any of these other kind of capital controls. So I think what it looks like on the other side partially depends on how long it takes. My base case is to see a more multipolar world. So you asked before, for example, what does this look like for other countries? Well, it partially depends on how effective they are at getting out of the problem. So to the extent that, for example, China can buy oil in its own currency, allows them to escape some of the downsides of U.S. fiscal dominance than if they were stuck buying oil in dollars while the U.S. is running a fiscal dominance playbook. And so over time, I think you probably would see more kind of bilateral trade agreements between large foreign countries, other economic blocs. But I don't expect, for example, any one of those currencies to become larger than the U.S. currency. They're either, the only economy at the same scale of the U.S. is China, and they've closed capital, kind of on their border, and generally they're not a super trusted kind of global partner. And so it's not that one other big currency takes over, but that you have a little bit more diversification of currency pricing or what kind of reserve assets central banks hold. So you get maybe less treasury purchases and more gold purchases because that's a market that they're used to. It's pretty big. Over time we'll see, for example, what happens to the size of the Bitcoin market in 5 or 10 years, or whatever else is happening here. Stable coins are an interesting variable because even as you have top down, countries are trying to de-dollarize, at the bottom up, people generally still want dollars. That's kind of their fiat currency go-to. And so stable coins are a way to basically get dollars in the hands of people, even as their top level is trying to de-dollarize. So stable coins can actually extend the extent that the U.S. is able to maintain some degree of kind of global reserve status. And people can think that's good or bad, but it's just kind of a factor that potentially extends it in the face of that kind of top-down de-dollarization. And so that's all the kind of big moving parts there. But basically, it kind of shifts to a more and more multipolar kind of reserve asset and bilateral trade agreement world. As far as what assets to own, generally, where possible, you short fiat currency, if you could, especially if you locked them in before rates went up, and then you own things that are scarcer. And then if you want to avoid tail risk, you diversify because, for example, you don't want to have everything in one asset, and then your asset became the scapegoat that got like an 80% tax put on it, for example, right? So it's not about maybe the asset itself does fine, but maybe you in your jurisdiction don't do fine with that asset. And so you either pay attention to what's happening in that area, or you own, for example, you might own your own house. You might then own Bitcoin. You might own a little bit of gold. You might own some energy equities, or you might own various equities that have locked in long duration rates, and then they have variable pricing power. And that could be in almost any industry. And so you own kind of this playbook that can get through things. Maybe if you want to have if you're older and you want to have lower volatility, you own things like T-bills or intermediate term tips rather than owning long duration bonds. Those are all kind of the different levers that someone can pull depending on where they live. What is their volatility tolerance like? What is their willingness to kind of concentrate and take on risk of that concentration, which could come politically as well. But basically, yeah, you want to own scarcer assets and be very careful about owning anything that's kind of just purely paper-based.
The surprising and unforeseen comeback of Keith Gill, the individual widely recognized for initiating the events of 2021. Speculators are buzzing with anticipation, wondering if we're about to witness a repeat of the GameStop short squeeze. While many are hopeful for GameStop 2.0, there is at least one analyst who remains skeptical. Gill played a significant role in the GameStop saga amidst the COVID-19 pandemic. During this time, Reddit traders disrupted hedge funds by capitalizing on their short positions in a supposedly failing brick-and-mortar game store. As a result, the price of GameStop stock skyrocketed by over 1,000% in less than a month. Some speculate that this short squeeze on GameStop also set the stage for a substantial surge in the value of cryptocurrencies like Dogecoin and Shabbat. After retail shifted its focus elsewhere, Inu followed suit. Gill disappeared from social media on June 19, 2021, only to make a surprising return on May 13 after a long absence. He marked his comeback with a mysterious meme featuring a gamer sitting up in their chair. It seems like he's back and ready to analyze the potential impact of the PPI numbers. A financial commentator discussed the macroeconomic situation this week, highlighting an unusual setup involving the Producer Price Index, PPI, and the Consumer Price Index, CPI. This presents a rare scenario for traders, as it doesn't account for unexpected variations in the data. Today, we have a unique situation where the PPI data is released a day before the CPI data. The commentator emphasized the strong correlation between PPI and CPI, with PPI often leading the way for CPI numbers historically. Therefore, any deviation from expectations in the data could result in a more significant market reaction than usual. The data from CME Group's FedWatch tool further emphasized the need for substantial surprises to cause a shift. According to current market expectations, the likelihood of the Fed implementing an interest rate cut before September is quite low. As of now, the probability of a 25 basis point cut at the June meeting of the Federal Open Market Committee, FOMC, stands at just 3.5%. The odds increase slightly to 24.6% for the July meeting. Let's get back to Lyn Alden interview.
So I think that, for example, Bitcoin and stablecoins are a big tool against this, right? So, for example, even in developing countries, the fact that people can, like, a Nigerian graphic designer could hold up a QR code on a video call or send me a payment string, an email or a DM, and have me pay her in whatever currency she wants, right? It goes around her local banking system, right? So that's a super powerful tool. That's infinite value density through ports of entry, and that's infinite value density peer-to-peer rather than through these centralized gateways. So that is basically the biggest tool against this is basically holding those assets, being able to transfer those assets is super important, which is also why you have to pay attention to jurisdictional risk. So I think that that's why part of my kind of case for being structurally long Bitcoin is this fiscal dominance environment. And then I do also pay attention to stablecoins, especially in that kind of emerging world phenomenon, because everybody wants to go up the stack, right? So if you're in Turkey, you want dollars or gold or Bitcoin or whatever the case may be. If in the US you have dollars, so stablecoins are less of an issue. But what these technologies do is they allow people more freedom of choice in whatever country they're in. They're able to go outside of their borders and get assets or get monies that they can't get just purely internally. And so it's basically the biggest tool we have against basically a complete kind of replay of prior fiscal dominance periods or the effectiveness of capital controls. And I think it's worth defending.
Bitcoin appears to have successfully navigated the potentially risky period following the recent halving event and is now entering a phase of reaccumulation. Based on historical data, a crypto analyst recently shared an update on the Bitcoin market cycle. They mentioned that the danger zone, which occurs when the asset corrects after a significant event, is now over. Bitcoin experienced a good bounce from the reaccumulation range low support. The analyst also noted that similar danger zones have occurred in previous market cycles when the asset retreats on either side of the event. In this cycle, BTC fell 23% from its peak price in mid-March to $56,800 on May 1st, potentially marking the bottom of the post-halving danger zone period. The analyst believes that if $56,000 was not the bottom, then this current pullback will have officially equaled the longest retrace in this cycle at 63 days. However, historical patterns suggest that the current pullback ended at $56,000 after 47 days. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.